Nice to meet you. My name is Ken, Equity Investment Specialist of Janus, Henderson. I hope all of you had a good lunch break. I'm from Singapore, but hands down, I think the food in Malaysia is still the best, right? So, very excited, to partner with RHBAM today to create this Sharia-approved Islamic Sustainable Future Technology Fund for you. Now, what really excites me about this fund comes down to one keyword, which is differentiation. So why do I say that? I think most of you here and most of clients are already overexposed to the Magnificent Seven, right? The technology names. So rather than giving clients more of the same, I want you to think of iSFT as something different. Now you might say, Ken, why would I want something different? For a very good reason. Now, ladies and gentlemen, if you have owned the RHB iSFT fund today, you will be up around 43% year to date. On a one-year basis, it's up about 80%, and over the past 3 years, it's giving you about 30% annualized return. This is phenomenal, guys. I think this is one of the best technology funds in Malaysia right now. Okay, so in terms of agenda, I want to cover 3 key things. Now, first, we all know technology is exciting, but we want to know what's next. So that's the first part. Now, second, I'm going to show you through some really exciting stock examples of how we create a differentiated proposition through the sustainable lens, a different angle to look at technology investing. Now, the third part of my agenda, we all know tech is great, but why should you choose RHBAM as your tech provider? Now, I want to start off with this very, very scary news over here. Over the past 12 months, it has been very volatile and scary. Now, if you take at the top left-hand corner, we have this apocalypse, the software sell-off in February 2026. Now, go over to your right, you have the US-Iran war. In the bottom right-hand corner, the very handsome gentleman over here, Jensen Huang, CEO of NVIDIA. You have one of the worst sell-offs since 2025, where within a day, $1 trillion was wiped off the market. Now, I understand, looking at this news here, is very terrifying. I would be terrified too. But if you had stayed invested, as I mentioned earlier, you have been up about 43% year to date. Now, this points me to this very interesting chart over here, talking about volatility. Now, for me, there's a very clear differentiation about risk versus volatility. Now, risk for me is like going to the casino. You play long enough, the odds are always against you, and the bankers always win. Now, volatility is different. Volatility is supposed to have ups and downs. It's supposed to go up and down just like how a market is supposed to do. In fact, if you look at this chart, this figure goes back all the way to 1994. Why is that? It's the year that Janus Henderson started managing technology funds. You would see, in fact, every year, there's drawdown about 20%, 25%, and so on and so forth. But that's not the fear. I think investing is like playing tennis. Any one of you play pickleball or tennis? Yeah? I see some people nodding their head. Now, the greatest of all time, Roger Federer, he has only won 50% of the points he has ever played. Ladies and gentlemen, 5-0. And yet, Roger Federer is the greatest of all time. Now, what is my point here? My point is you do not need to win every single day in the market. You just need to stay in the tennis court long enough, just like Roger Federer. They say time in the market, not timing the market. Just take the past 3 years as an example. In 2023, if you had stayed invested, it's giving you about 50% of tech returns. The next year, 30%. 2025, about 20-ish% return. So guys, the biggest risk for me is staying on the sidelines and not staying invested and potentially missing out on what could be the next 5 to 10 years of great technology returns. Now, the next bit, I wanted to share on what's next, right? We all want an update. Now, if you take a look at this, 3 years ago, we're at this point called generative AI. I'm sure all of you have used ChatGPT, Copilot, and generate some kind of videos or images. It looked terrible, right? You probably have like 7 fingers, distorted face. Now, 3 years later, it still looked terrible, but terribly real, right, ladies and gentlemen? You open TikTok, Instagram, you can't even differentiate whether it's real or fake nowadays. Agree? And what has caused this? It's the arrow that you see here. Billions and billions of money pouring into compute power to a phase where we are at agentic AI. Now, what is agentic AI? This is the phase where us humans, we take a step back and let agents do the work for us. I'm sure some of you have watched the movie Limitless in 2011, the very handsome Bradley Cooper. Imagine you could have 1 million Bradley Cooper working for you 24/7, never complaining, never asking for pay raise, just working for you in the background. This is agentic AI, ladies and gentlemen. Companies like Airbnb is using that worldwide. And finally, physical AI. How many of you watch the February Chinese New Year Chun Wan Yan show? You seen robots doing martial and wushu art? Phenomenal, right? You have seen robots participating in marathons. This is why we're still excited about technology in the years ahead. Now, the next bit I think some of you might ask is, can we make any money from AI? Now, the answer is yes. Now, just to give you some statistical reference, this is Anthropic's recent report. Now, it took Google 11 years to reach from $10 billion of revenue to 100 billion. It took Meta, right, the previous Facebook, about 7 years to reach that figure. Now, does anyone here wants to guess how long it took Anthropic? Anyone? Any volunteers? 1 year? Wow, very optimistic. Almost there. Anthropic's probably going to do it in about 2 years or so. Wow. Our portfolio managers in their 30 over years of managing technology have never, ever seen anything like this. Ladies and gentlemen, this is the real opportunity to make money in technology. And why are they making so much money? It's one very simple thing. It's this thing called tokens. Now you might say, Ken, what are tokens? Tokens are that single thing that you press and they generate every time you press enter in ChatGPT or Copilot or Claude. Now, the data in October 2025, Google processed about 1.4 quadrillion tokens. Now, I do not know how many zeros are there behind quadrillion, but for sure that's a lot of zeros. And what do Google use it for? Things like customer service, Airbnb, for healthcare, right? You think about Alzheimer's, cancers, all the terrible disease in the world, they are now using AI to find solutions, unmet medical needs. What could potentially take 10 years to find a solution may now potentially take just a few years. This is because of AI. Now, what will blow your mind, everyone, this is the data that I'm showing you. It's before the proliferation of agentic and physical AI. This is only from ChatGPT. Now, imagine the amount of tokens we are going to use in agentic and physical AI. And that's why we believe there's still a lot of opportunity ahead. Now, some of you might say, Ken, technology is great, but I haven't started investing yet. Are we too late in the game? The answer is no. Now, this chart shows you the way to look at technology investings. Over the past 100 years or so, there are 4 compute waves. The first one starting from PC mainframe. Back then, your computer were as big as a box, right? As I certainly never came across that. And then you have internet. And then the third wave is your smartphones. And finally, as you can see on the right-hand side, ChatGPT just launched in 2022. Now, just to give everyone a thought process, imagine in 2010, you told yourself that Apple stock is so expensive 3 years after the launch of iPhone. And you say the same thing right now. You say, Apple is such a hype, Apple is a scam, I'm gonna get out. Imagine how disastrous that decision would have been. Apple is now a multi-trillion-dollar company. Now, we think the exact same thing is playing out in the AI era. We are just 3 years after the launch of ChatGPT. There is still a lot of opportunity ahead, right? Because one thing people might say, history doesn't repeat itself, but history rhymes. So just take a look at the orange numbers over here, right? This tells you how long each compute wave actually lasted. It lasted about 20 years, 10 years or so, right? And we are only 3 years after the launch of ChatGPT. Again, guys, a lot of opportunity ahead. And the next question I always get from clients is tech expensive? That is totally not true. And we created a slide just to show that. Okay, on the right-hand side, you have some of your technology names. And one of my favorite one, you have NVIDIA, a company that make chips, computer chips. Okay, it's trading at about 15 times PE, price earning ratio. Now take a look on your left. There's another company that also sell chips. Potato chips. Correct, McDonald's. How much is McDonald's trading at right now? 19 times PE. Which chips will you buy? One gives you 50% increase in return year on year. One sells you a Happy Meal. Technology is not expensive. And it's not just NVIDIA. You take a look at companies like Amazon. It's trading at a 40% discount to Walmart, a supermarket. Amazon is one of the largest technology company in the entire world. Or things like memory, SanDisk, Micron. You know, my impression of SanDisk was an old thumb drive. But SanDisk has been up about 800% the past year. Micron, 1,000-ish%. Now, the amazing thing is that even after this amazing run, take a look at the PE ratio. It's at 10 times. Why? Because PE, price, is a fact. You could search it up on Google. But what you cannot find is the E. The E is an earnings estimates, right? If it's so easy, then you don't need Janus Henderson, right? Because most of the time people get the E wrong. And that is the reason why SanDisk, after going up about 800%, the PE ratio is still at 10 times. So, ladies and gentlemen, the bottom line of this slide is tech is just not expensive. Don't believe what you hear on the traditional media. Now, I'm going to start in this slide, and I don't just want to paint you sunshine and rainbow, okay? Because investing in technology do come with volatility, right? So what we want to do here is 2 things. First, we do want to get the AI winners right. But second, we also want to avoid the companies that will be disrupted. So what do I mean by that? Look at the companies that you can see here on this screen. I give you a perfect example, Check. Have anyone heard of Check? No? I used to pay about $10 per month to subscribe for this. It provides you with a proprietary database, for example, for your university answers, for your research. Right? Please don't tell my lecturer I did that. Now, The CEO of Check actually met one of our team members back then when ChatGPT launched. And they say, oh, AI is amazing. We're going to use AI to transform our business. But ladies and gentlemen, if you just take out your phone and you Google Check share price and you just click max, you will see that Check is now down about 90%. 90. Okay? So my point here is, in every new inflection point, every company is going to tell you they're going to use AI and do amazing things. But will you believe them? Okay? So this is where we add value. We navigate the hype cycle and avoid losers like this. So the second section of my sharing today, I'm going to share with you some interesting stock examples of how we show a differentiated proposition. So each of the companies that we invest have to tie back to the themes here, right? And I'm going to share with you things like low carbon infrastructure, smart energy, and things like that. Now, the first example here is low carbon infrastructure, right? A lot of people say, oh, AI is so power intensive. Why don't we just go buy utilities companies? No, that's not what we do here in Janus Henderson. Why? Think about your smartphones or the phones my parents used to use. You know, in my parents speak Cantonese, they used to call the phone "tai go tai," right? "Da ge da." It was as big as a brick. It was expensive. You know, you're probably only gonna get 1 hour of battery back then. So was the solution back then to build bigger phones? I'm sure none of us want that, right? The solution was to make it more efficient to a point where each one of you currently have a smartphone in your pocket, right? And it's cheap, provided you don't buy a brand new iPhone 16. So the key word here is efficiency. And companies like NVIDIA, when they launch their chip, the Blackwell chip, it has more than 30 times the performance. So it's going to get more efficient, more and more cheap as we use more of it. Another example here that I love to give is this company called Flex. Now, people's memory of Flex is just a boring contract manufacturer. But what Flex does is incredible in this new AI inflection. Why? Because AI data centers, they run so hot and you need the power and cooling systems. And Flex actually provide a solution to the power shelves and design products for the next Vera Rubin or companies like AMD, you know, a company that's done phenomenally well. So this is a perfect example of a marriage between technology and sustainability. Now, the second example I have here is in terms of clean tech. What you have here is Next Power. So at the core of what Next Power do, it makes solar panel. Now you might say, Ken, what's so amazing about a solar panel? Now what Next Power does is very simple. It makes solar panel that adjusts accordingly to the movement of the sun across the day, so that it captures most of the sunlight as it moves. Now, it's something very simple, but it actually maximizes the energy output. And this is a company that has done phenomenally well and is able to increase its production, reduce its price, and it's one that has done phenomenally well for the portfolio. Clean energy, clean tech. And next, cybersecurity. You know, I painted a very fanciful image about agentic AI earlier, right? But the thing is, I'm not too sure if any one of you has used things like OpenClaw. Yes? Right? It's so amazing. You use OpenClaw, you could literally see the mouse moving on your laptop, clicking into website, making payments for you, and it will even tell you that the transaction is completed. Now, what this does is you introduce a lot of cybersecurity risks because you have to give your credit card information, your personal details. So if you think as AI as the engine and the accelerator, now cybersecurity is your seatbelt. You are going to need both. So there's a company that we love here. It's called Palo Alto. Okay, it's a name that we think that got thrown out the baby out of the bathwater during the SaaSpocalypse. Now it's a very old term, throwing the baby out of the bathwater. Why? In the olden days, the seniors and the oldest get to bathe first because water was expensive. Now by the time it reached the baby, the water was dark and murky. So someone might have accidentally thrown the baby out with the dirty bath water. But the baby is good, right? And we think Palo Alto was one of those baby. In fact, if you search Palo Alto share price today, it's done phenomenally well. It's a conviction that we've held despite the SaaSpocalypse in February 2026, the slide that I showed earlier. The next team here is Tech Health. Now, this is amazing. This is something that I'm very passionate about. Companies like Intuitive Surgical. Now, think about that. The next time your family or friends, they need a surgery for their medical condition, the doctor that speaks to you will probably tell you they are the best surgeons in the world. Will you believe them? I wouldn't do so. But that changes with AI. That changes with Intuitive Surgical. Right, they built these robotic arms that learn from one of the best doctors in the entire world. And the next time the doctor performs the surgery, it's not only relying on his own muscle memory, but also built into the robotic hands with the best surgeons in the world. I think every patient deserves the best surgeon, and AI is how they get one. And the last bit here, we have here sustainable transport. This is an interesting one. I like to think of this as pick and shovel. So what does pick and shovel mean? I want to share a very fun story here today. In 1800, you have this gold rush in California. And a very wise man called Levi Strauss, he didn't rush to find gold. Levi Strauss, sounds familiar? You might be wearing his jeans right now. What did Levi sell? He sold hard, durable workwear to the miners. They all needed it. And the rest, they say, was history. So what Levi did was selling the pick and shovel during a gold rush. And we think it's the same for EVs and sustainable transport. Why? Because if there's one thing the world has learned over the past few years, from Russia-Ukraine to Iran war, is that if there's a cyber attack or Iranian missile, and boom, suddenly the question isn't, do we have electricity? It's, do we have electricity when we need it? Now then enter the solution of storage. You have companies here like CATL, right, which is an EV battery maker. Now, the interesting thing is, the battery is not just going to go into your EV in future. It's going to go into your AI data centers. It's going to go to your EV grids and your solar panel as storage. And this is the pick and shovel that nobody thought of, because everyone is rushing to NVIDIA. Everyone is rushing to GPUs. And finally here, the last theme is resource and optimization. A very simple fact that the world is getting old, people. 10,000 people a day in the US turn 65. Now what happens? Golf clubs and cruise ships get crowded. So the world is getting old, but the work isn't getting any lesser. Look at the amount of work I have to do every single day. So the world has recognized you need to do more with less. Enter technology solution that will fix that. Names like ServiceNow, it's a company that we love, right? You raise a ticket, it routes to the correct person, right? It gets the correct solution and it closes itself altogether. And the thing about ServiceNow is that it works with large organizations, and once in the system, it's a nightmare to tear it out, right? You guys talk about migrations. It takes years, and ServiceNow is one company that we love. Now, entering the last bit of this sharing, I just want to quickly share why should you choose RHB as your tech provider. I think it's for a fact that as the investment advisor, Janus Henderson, we are managing one of the oldest and largest tech fund in the entire world, period. You know, this very handsome man at the top right-hand corner, Richard Claude, he has about 23 years of tech investing experience, and he likes to say he's one of the least experienced. You know, fortunately, that's true, but this goes to show you the credentials of the team. This team has been here for a long time. Now, a wise man once told me, just because a person has lived long enough, does it mean he's a great person? Maybe not. So my point is, this fund, the tech funds that our portfolio managers manage, did not just survive, but had also managed to give clients a great upside too. Like I mentioned, 43% year to date. The tech funds that they manage since inception is given about 13%. The last 10 years, about 20%. So this is a team that have track record and has a differentiated proposition. Now, for clients, lastly, who already own tech fund, I think this is a very complementary proposition, right? And the numbers have shown it all. So I'm going to take a pause here. I'm over about 25 minutes for questions. Happy to answer any of them about the latest update on markets or tech.
What do you think of SpaceX?
Phenomenal question, right? In fact, I did, you know, if one of my first slide, I actually put SpaceX there. I think SpaceX is a phenomenal company. I think everyone's excited about it. If you look at what get people really excited, at its core, SpaceX has one of the busiest rocket launch businesses. It has XAI, and also they're talking about data centers in space. Now, that is what really got people so excited. But as of now, it's still very much an unproven concept. So in terms of IPO, if you look at the prices, I think the keyword here is timing, right? Sometimes the best timing to enter may not be always the first. I give you one example. In 2012, Facebook IPO at about $38 USD. Now, the next few months, Facebook share price actually plunged about 50%. It took more than a year or so for Facebook to recover back to the original $38. Now, the same company today, Facebook, is worth multi-trillion dollars. And obviously, you know, we kind of added Facebook, now called Meta, along the way in our portfolio. So I think the keyword here is timing. Right now, everyone is hyped up about the market. Everyone wants to get in. But it's very important in this crucial phase not to be caught up in the hype cycle. You don't want to pay an overly expensive price at this moment. Yeah, but fantastic question.
Hi, my question is, do you think China's AI sector will be a disruptor for the US AI sector?
Yep, I think that's a very good question. In fact, if you actually look at the portfolio where we represent, about 80% or so of the portfolio is actually US exposed. So from the portfolio manager point of view, we still see majority of the opportunities still lying in the US. That's where we see it. It's not to say that there isn't any in Asia or China, but it's just that there's lesser. And when there is, everyone just rush to get those Chinese names. And what happens as a result? It gets more expensive than it should compared to the US where there's much more opportunities. But the thing about China is amazing, right? Because number one, you talk about chip design. Maybe they are not going to be the best chip design like NVIDIA, right? But it doesn't matter for them because what they did, for example, in the case of DeepSeek, I remember it was just during Chinese New Year dinner, right? NVIDIA plunged 20%. The thing with DeepSeek is that China was able to use what we call the distillation model, using an existing model and make it even better, right? So for example, they were very good at it. and they were able to roll out things like physical AI. I shared in my slide earlier, in the next phase that we are going at is agentic and physical AI. China is very good at that. If you, I'm not too sure, any of you been to China recently? Yes, see some people nodding their heads. You see China rolling out autonomous driving, physical AI. China has one of the largest manufacturing base in the entire world. And you're using robots. I talk about efficiency, right? Demographics, people are getting old. So you see China being very good at that. And if you look at China, it's very different from today. And I think within the portfolio, we still look at that, but it's just not as much in the US as of now.
What's your thought on existing tech companies like Intel, which actually the share price has actually, I mean, in the past decade it's been sort of sluggish until they gave the Trump administration part of their share. So I mean, going forward, is that something interesting in that organization, or how do you see it going forward?
I think that's a fantastic question. Intel, I think it was not only dead and buried, it had grass growing over its head. A very good question, because I think, in fact, in 2025, as you rightly point out, the US government actually stepped in to provide actually aid to Intel. So the way to look at Intel is, it's not that they are doing something different now, right? They are not trying to compete with NVIDIA, like to be the next best chip designer. But I think what we see is a change in strategy in terms of chip manufacturing. So why do I say so? If you look at the recent news, what Donald Trump has said, right, with TSMC, right, a lot of NVIDIA chips is manufacturing out of the US. And for Donald Trump, he has publicly said it's national security risk. And yet he wanted diversification, and Intel, was probably one of the companies that the US government see the potential, and as you rightly mentioned, has provided aid to. So I think that plays a part, one, in terms of manufacturing and support. And secondly, you have a lot of exciting news that have recently played out. You have seen Intel collaborating with Apple, right? It hasn't been said which Apple products they're going to work with to produce maybe the next chip in terms of manufacturing. But obviously, when you see such collaboration and the revival, it spikes a lot of excitement. But as of now, it remains yet to be seen whether the ambition meets the execution. But of course, maybe 3 years down the road, Intel could very well do it, be one of the best at doing it. So it remains yet to be seen. But fantastic question.
Hi. I'm just considering there's another fund managed by Richard Claude, Janus Henderson Horizon Global Leaders Fund. I'm not sure whether I got the name right. So as that is also a tech fund which has a very strong track record. So comparing that, besides the fact this is Sharia based, why overweight in this fund?
Fantastic question. In fact, the other fund that managed by Richard Claude is also by us, Janus Henderson. So we manage both TA Global Tech, the RHB Islamic SFT fund. Both, we like to call it both our babies, right? But of course, if you look at it, it's very different product differentiation. If you look at the RHB iSFT, you're looking at, for example, the market cap is hovering about 550 billion. So it's more of a mid-cap kind of tech fund. And obviously, with the sustainable lens, a differentiated way to look at investing in tech. So one example is, if you look at our top 10 holdings, it will actually look very different from some of the usual tech funds out there. And why? Because the opportunity is actually broadening out of the Magnificent Seven, out of the so-called acronyms. Why? Because back then you have acronyms like BRICS, and then FANGs, Mag 7, and now finally you have acronyms like Mangoes. So the thing is, Mag 7 worked well. 2024 was very good for your portfolio. But in 2025 and 2026, it didn't do very well. Only 2 or 3 out of the Mag 7 actually did well for your portfolio. So my point is, the opportunity is broadening out, and you need experts like here to find opportunities beyond that, which is a case example of how it actually worked well in this portfolio, beyond the mega cap names, names that, even I myself, I probably not heard of. So I would say that's a differentiation, and it's a complementary, for clients who already have tech in their portfolio. Yeah, hope that answered your question.